2020 and you didn't receive that full $1,200, maybe you were in a phase out, or maybe you had a new baby in 2020 that they didn't know about in previous years, you have the opportunity to get that full amount. When you file your 2020 tax return, they will see that and you'll be eligible for more stimulus money up to the maximums previously allocated in the CARES Act at that time. Now, if you never received your payment, or maybe you received it, but you thought it was junk mail and you threw it away, there is something that you can do. Go to irs.gov, the website for the IRS, and on the left-hand side, there's a button that says Economic Impact Payment. Click there. There's a little calculator that'll help you calculate how much you should have received. And there is also a FAQ, a fact page, that tells you what you can do if you lost it, or if you threw it away, or if you moved and you never received it. There are some procedures. Again, anything with the IRS is not real warm and friendly. It's a little painful, but I promise, I have navigated the system myself. If you need some assistance from them, you will get it eventually, and you will be able to receive your stimulus money. Next, we're going to hear from Beth, and she is going to talk about charitable deduction changes for the 2020 tax year.
Thank you, Kay. This above the line charitable donation that I'm going to talk to you about real quick is part of the same CARES Act that Kay was talking about, in the same CARES Act we've been talking about all year in all of our Zoom meetings. But just like everything else that we've been talking about all year, every day different, regulations, interpretations are coming out. So this is kind of the information that we have available right now on this particular deduction. This is for your individual personal tax returns. When you file your personal tax returns, you get either a standard deduction or an itemized deduction. Your itemized deductions are your charitable donations, your real estate taxes, your mortgage interest. People refer to it as your Schedule A, the long form, your itemized deductions. The other one is your standard deduction. So if you don't qualify for the itemized because you just don't quite have enough of those types of expenses, you get a standard deduction, which is a flat rate. Now, what the CARES Act for 2020 has done is they brought back to us what's called the above the line charitable donation. What this allows you to do is, if you have a standard deduction, and only if you have a standard deduction, there's no hybrid with having itemized. If you have a standard deduction and you made charitable contributions, you are now eligible for, at this point, $300 to be used to reduce your adjusted gross income, further reducing your taxable income, further reducing the tax that you have due. Now, this $300 is for cash donations only, not when you go to Goodwill, not when you give books to the library. This is a cash donation only to a qualified 501c3. And a lot of people who have these standard deductions have maybe not in the past thought about telling us, their tax preparers, or if you're not one of ours, one of your tax preparers, that you have this. So please make sure that when you're giving your information to your tax preparer this year, include this in there. More information will be coming out on this. So regardless of what the dollar amount is, tell your tax preparer how much it is. Like if you gave $100, $5,000, let them know so that we can make sure we don't miss it, because being new, and if this is not a deduction you're used to having in the past, it could very easily be overlooked. So yeah, that's something new to look forward to. It's almost everybody will qualify for it. So just make sure you remember that it's out there and that you let us know about it. And with that, I am going to hand it up to Jack, who's going to talk to you about how you can get some quick refunds off of some current losses you might have had.
Hello, everybody out there. Belated Happy Turkey Day. One of the rules that had been in the law in the past had to do with net operating losses. That would be either a net operating loss for a C corporation return, or even you could have a net operating loss on your personal return. What that means is basically you ended up with negative taxable income on your personal tax return. And prior to 2018, the rule is that you could elect to either carry the loss back so you could use it against income in a prior year, or you could elect to carry it forward and use it in a future year. Well, when they changed the tax laws in 2018, they eliminated the carry back altogether, and they said you have to carry it forward. So far, so good. Now comes the coronavirus along, and they decided that maybe people were really suffering economically, maybe we would change the rules to allow them to now carry it back again. So they kind of did this retroactively. And so what they said is if you had an overall loss in 2018, that under that new law, you would have had to carry forward. They came out and said, well, you know what? We changed our mind. And if you want, we'll let you carry that 2018 loss back 5 years, in which case we would take a look at your returns from 5 years ago and then decide whether we wanted to carry it back or carry it forward. If you had an overall loss in 19, they said, if you want, you can carry it back 5 years. In that case, it would be to your 2014 return, or carry it forward. So I know when our clients, basically what we did is we went through like our entire client database to first determine, well, did clients have losses in 18 that we didn't carry back at the time? Well, because at the time, you weren't allowed to carry them back. And so the issue then is you need to take a look. If we're not our clients, you need to take a look at your 18 returns. Did you have an overall loss that you could have carried back and maybe didn't carry back? And the same thing for 19. Did you have a loss that you could have chosen to carry back, but you did not? And so that's kind of where a little strategy on when your preparer comes in, because what your preparer should be doing is kind of telling you, does it make sense to carry it back, or does it make sense to carry it forward? Okay, very good. And at that point, I will turn it back to Gary.
Thanks, Jack. I know that we have had quite a few clients that we filed those carrybacks for, and some of them are getting a lot of money back. So
it's like finding money for free, my friend. You know, as Dire Straits would say, money for nothing, chicks for free.
That's right. I'm going to talk about retroactive refund for bonus depreciation. It's a mouthful for me. So when the Trump tax rules came into effect, when that passed in late 2017, the language of the final law did not include qualified leasehold improvements in the definition of property that's available for the 100% bonus depreciation. This was a technical error that everyone kind of expected was going to get fixed, and it hasn't, and we've been waiting for it. It hasn't come, well, until this year. I mean, as always, Washington is very slow getting it, but when they did the CARES Act this year, they put that language in there to make that subject to the 100% bonus depreciation. They also made it retroactive. So back to 2018. Qualified leasehold improvement property is generally any improvements you did to a building, a business building, inside the interior walls. So if anyone did improvements in 18 and 19, you're now going to be entitled to go ahead and expense all of that. But there is some tax planning involved in this, because they're going to allow you to either go back and amend those returns to take the deduction, or you're allowed to take it all in the year 2020. So part of the analysis now is going to be, where do you get the best tax deduction, 2020 or going back? Of course, as we're doing our clients, we'll be looking at that. When we're not only here for you to tell us, but we will be looking at your tax returns as we do them to see if this is a deduction that maybe we could go back and change or get into 2020. So keep in mind that when you're doing your tax, when you're bringing your tax information into us this year. I'm going to now turn it over, and Lisa's going to talk about SBA loans.
Great. I feel like we've been talking about those for like 10 years now. It's been really 6
At least.
So many small businesses took advantage of the Paycheck Protection program this year. We did a lot of these types of meetings, helping you with them and helping you obtain them. So I think most people at this point know the point of it was to receive money in the form of SBA loans that would later be forgiven to use for payroll and related expenses. When the CARES Act came out, it was specifically excluded from income. So this money would not be taxable per se when you got the money. Recently, the IRS came out and indicated that although the money was not taxable when you received it, you would not be allowed to deduct expenses paid with PPP money, which essentially makes it taxable. This contradicts what the intention was when they passed the law, and there's been a lot of discussion about it. But at this point, the IRS has come out and said, Congress passed a law if you want it to not be excluded from deductions. So we are looking carefully for the next stimulus bill to address this, the non-deductibility of PPP expenses. We are hopeful that in the next bill, this will be something addressed and passed, so it won't be an issue to anyone that has received the funds. But as of right now, your expenses are non-deductible, so you should carefully consider this in your year-end planning, that it is a large uncertain item that we're dealing with at year-end. So consider that when you're spending your year-end money, that this could be an issue. And so again, we have our fingers crossed, but we want to make sure that everyone's aware of that so that there's no big surprises. As a side note on that, we are assisting clients with a lot of you probably with PPP forgiveness. We are still advising clients to hold off on that because this is just continuing to evolve. We're getting more and more information. There's no reason to apply right now. So this month we're gonna start assembling applications, put it together, gathering documentation, but we're not suggesting you apply for forgiveness at this point. Now, I think that covers all the 2020 new special tax planning topics we wanted to talk about. I think we wanted to move on to some traditional year-end tax planning tips, starting with Beth talking about W-2 withholding. Yes, thank you. As Lisa said, this next round of the topics that we're going to talk about, these are not new. These are just things that are pretty common, and we would like to bring them up again for you here at our year-end Zoom meeting. I'm going to talk about estimated tax payments and what happens if you miss them. 2020 was a weird year, the way the dates were due. Your estimated tax payments for your tax returns are due in April, June, September, and January. The IRS requires you to make your payments evenly throughout the year using those months in order to avoid penalty and interest for late payment. I've heard everything across the board this year has been nuts for everybody, so this is a specific year where this might be something new. A lot of people didn't realize the July 15th one this year was for first and second. So I can tell you handfuls of people missed the second payment because they thought there was going to be another later date. And so a lot of people still don't really understand how that concept works, and they say, oh, I paid all my taxes April 15th when they're due. Well, that's great that you paid them in because now you don't have additional penalties, but the penalties and interest for your taxes that are due have already started to accrue on your tax return this year, for this year as of July 15th. So if you found yourself in this position where you're like, oh no, I didn't make any estimated tax payments yet, do I have any options to alleviate or minimize some of these penalties and interest? If you have access to your payroll, if you're like a S corporation, single owner kind of thing, or even if you have employees, but it's you we're talking about here, you can run yourself a bonus check at the end of the year here. It's like the 3rd, so you've got like 27 days to do it. What you'll do is you'll run yourself an extra check, and instead of taking your little net check home, or your big net check home, depending on what kind of salary you have, you put all of that excess money into your federal withholding. And even if you make that federal withholding done on December 31st, when the IRS sees it come through your W-2 as a federal tax payment, they backdate that to the beginning of the year. So it's as if you've already received, the IRS has received that money from you evenly throughout the year, effectively reducing those penalties and interest almost to zero if you get enough in there. Now, this is not a 100% way to go, so I don't want everybody calling me when I get off the Zoom in an hour saying, hey, I need to run a bonus check, because it doesn't always work out that that's your best way. Literally, I was on the phone this morning with a client, and we ran it that way because they had not made any estimated tax payments. But when we looked at what their penalty was going to be for paying all of it late, even if they pay it right now, it's all late, the estimated penalty that we came up with was 1/3 of the amount of payroll taxes that they were going to pay in. So it wouldn't make sense at their point. They already had a salary, they were already in compliance there, so they were getting no benefit out of doing this method. However, if you have not run a salary at all throughout the year, it's a twofer. You're going to get a little bit of compliance in there because you're an S corp, you needed to have your payroll. You're going to get some of your federal tax paid in. You're going to save a little bit of penalties and interest all over the place. So just don't automatically think one way or the other. So if you are in this position, reach out to us, let us know, say, hey, I haven't made any payments, what can I do? And we'll run some scenarios for you.
So to follow up though, what you're really saying then is that you don't necessarily want to run additional salary to be able to make the additional payments. However, if you're going to have to run additional salary anyway, because you haven't met the IRS test for reasonableness, that's the way to make up for it.
100%. You're going to save all kinds of money on that one.
There you go.
The other thing is people with retirement monies, you're not required to take your minimum distributions. But I had a couple of clients do it just because to get the withholding, you can do that on that. You do get tax on the distribution, but you can get that additional withholding. And when we did those estimated payments, it was based on them having withholding from some of those 1099 retirement monies.
Yeah.
So even the estimates we set up, we're going to end up low. So not only with W-2 wages, some of you, can't affect that too much. Retirement monies can be looked at too.
That's a good one.
Yeah, and I would think if it's not, depending upon how late in the year it is, it may not be too late to call the brokerage house that's giving you the pension money and say, hey, do me a favor, instead of maybe sending me that last check, send it to IRS.
Mhm.
Yeah, so you're right, you might be able
That's a
to.
good one.
And if you're charitable minded, you can still use that retirement to pay charity and some withholding.
Hey,
Yeah.
you're hitting all the boxes.
And let us not forget, you can always advance pay. Campbell Jones Cohen. your
At least we'll get to that.
your preparation fees for the next 20 years. Okay. That's always a good deduction.
Yes, paying your CPAs is our favorite deduction.
That's right. We like that one.
All right, and with that, we're going to turn it back over to Kay, who's going to talk to us about maximizing our retirement contributions. Leading right off again.
All right, thank you, Beth. Yes, I really enjoy talking about maximizing retirement contributions. I get to talk about it quite a bit because people always come in and say, oh, I want to save money on my taxes. What can I do? The number one way that you can save money on your taxes, while not sexy or glamorous at all, in fact, it's deferring instant gratification. It's taking away something that you would receive right now and putting it away for later, is maxing out your retirement savings. But I know that all of you are going to want to retire, except for, of course, Jack and Gary, who have agreed to work here forever and take care of all of you. But if you have a 401k plan at work, you really do need to maximize it and max it out. And right now in 2020, that means $19,500 is the max that you can put in. Now, if you haven't started doing this, it's too late to really get much bang, because there's probably only 1 or 2 payrolls left in this year, unless you fall into a category that I'll talk about in a minute. However, I do suggest taking a look at retirement savings in your tax planning strategies overall moving forward, and contribute something, especially if your employer, your W-2 employee, and your employer has a matching contribution. At least contribute up to there, and then try to up it 1% a year. That's my suggestion. You won't even feel it, but you'll be happy to have it later, and you do get a deduction. Then the next question is, well, how much? How much of a deduction do I get? The amount of deduction that you get is equal to your tax bracket. So if you are in the middle American tax bracket is generally 22%. If you maxed it out at $19,000, you would be just under a quarter of that. So it would be around $4,200 in tax savings, which, yeah, it's something, it's nothing to sneeze at. So that's something to know. But next you say, hey, I didn't do that. What can I do? Well, there are individual retirement accounts, IRAs, and everyone pretty much is able to put money into an IRA, but it's not always deductible. So we'll talk about that in a minute. Right now for 2020, you can put $6,000 into an IRA. If you're over 50, if you're 50 or over, that can be $1,000 more, $7,000, and that is individual. Retirement's always individual. So for married filing jointly, that would be each. If you have access to a retirement account at work, the IRS says, gotcha, a little bit. There are some income limitations to that whole amount being deductible. So if you, whether or not you're involved in it, if they offer something at work, be aware that there are some income limitations to the IRA being fully deductible, and ask Dr. Google what that is, and you'll know if that affects you or not. Now, if you're self-employed, if you're, say, a single member S corporation, you do have some other options. As we were just mentioning with payroll, we do have a number of S corporations with with one solo member who run their payroll at the end of the year and cover their withholding. If you have cash and you haven't contributed to a retirement account but would like to, you can still do that if it's just you. You could have a solo 401k program set up. You would need to move quickly if you want to do this, but you could still do a payroll here at the end of the year and make that contribution $19,500. Additionally, your business can contribute can match that up to 25%. So that's a pretty substantial amount that you can put in. The employer matching contribution, the 25%, does not have to be made by the end of the year. So that's a good thing to know. And I failed to mention when we were talking about IRAs that you don't have to decide today on that IRA. You have up until April 15th to make the decision. So keep that in the back of your mind too. When we come to have our tax meeting and you go, oh, I owe too much, what can we do? Remember that that is something that we can do. It does take some cash, but it does save you some tax. Also, one last topic that I'll just throw out there are SEP plans. SEP plans are for businesses. They are made by the business for the employees of the business. So this could be very beneficial to you if you're the only employee, because all the contributions go to you. If you have several employees or many employees, keep in mind that you do have to share. So if your employees make, I don't know, half as much as if there are different salary levels, you would need to share the contributions ratably. But it is a way for the business to put away money. The good thing about a SEP is you don't have to make that payment until the extended tax filing deadline of the business. So you have plenty of time to think about it. And you don't have to do the same thing every year. If you find yourself with a lot of cash this year and this is something you want to do, that might be something to think about also. And that kind of concludes what I have to say. Next, Gary is going to talk about one of my favorite topics because I think it sounds fun, harvesting stock losses.
Thanks, Kay. Thanks for the retirement stuff, but remember, very complicated.
Yeah.
And we're running out of time, so get a hold of us to review through those options. She gave you a very good general overview, but there are a lot of twists and turns in there to see what you can and can't do. So thank you. So I'm going to talk about harvesting stock losses. And even with the pandemic this year, the stock market has done very well. And a lot of people took a lot of gains, sometimes not knowing what was going to happen, so they decided to lock in those gains. But now's the time to kind of look at your portfolio and see if you have some holdings that are in a loss position that you would maybe want to liquidate by the end of the year or could liquidate by the end of the year to offset some of the gains you already had. Capital losses can offset capital gains dollar for dollar. If you go over and above, you can go 3,000 against other income. Any that isn't used carries over to the following year. So it's a good idea to try and match those up. So when I'm talking about capital gains, you got to look at what you've got. And remember, you get capital gains from different sources. So not only selling the securities, but you get capital gain dividends on some of your investments. You have sale of real estate or other capital assets. Also, I've had some things this year where people have been paid off on old installment sales that equates into some capital gains. So if you do have some that you can liquidate and want to liquidate by the end of the year to offset some of those gains, don't forget about the wash sale rules, which say if you sell an investment and you reinvest in substantially the same investment 30 days before or 30 days after, that loss is disallowed. So be careful not to fall into that. And as we were going through this, Jack reminded me that those wash sales only count for losses. They don't count for gains. You can sell a stock at a gain and immediately reinvest in it without any adjustment. That could be helpful if you have a lot of capital loss carryover, or you've already sustained some capital losses this year and you've got some equities or that you could sell and take a gain to offset those losses. It doesn't cost you any tax now. You can reinvest in the same stock the same time, and now you have a higher tax cost basis for when you sell it later on. I want to reiterate, capital losses can only be carried forward. They're not carried back. So I hate that situation where I see someone get a big capital gain this year, and then the next year they have a large capital loss. I can't carry it back and offset it. So timing of these things is crucial. So bear that in mind. Now it goes to Lisa, talk about some deferrals.
Okay. The majority of our small business clients are on the cash basis of accounting, which essentially means you report income when you receive the money and you deduct the expense when you pay for the expense. The alternative is accrual basis taxpayers who record income when earned or when you bill your customers, and expenses when incurred, and they still could be accounts payable and not paid, and you get the deduction. We wanted to talk a little bit about cash basis taxpayers because it allows a little bit of flexibility at year end. You can control the timing of that a bit. In 2020, if it was a profitable year for you, there may be some reasons to consider not hurrying up and harping on your customers to pay you prior to December 31st, because if you have a large payment that comes in December 31st, you're paying tax on it this year. If it comes in January 2nd, you're deferring the tax an entire year. So if you are cash basis and concerned about income this year, don't be in a hurry to collect all your receivables before year end. The alternative, it's a good idea to look at all your upcoming expenses and see if there's anything that you might want to consider prepaying before the end of the year. Think about things such as rent, commission, dues, as we not so subtly mentioned, accounting fees, even payroll. If you are someone that runs your payroll on the first of January, first of the month on a recurring basis, running that payroll on December 30th, 31st will get you that deduction a whole year ahead. So there might be some strategy if you have a good year this year to look at decreasing your income using this deferral. December is also a good time to look at equipment purchase that might be necessary. We never encourage people to spend money just for the tax deduction, but we always look around and say, what kind of equipment, what kind of computers, do we need furniture? Those types of purchases are better made in December, considering that we have 100% bonus depreciation. You can write those things off rather than in January or February. Again, you get the deduction a whole year earlier, which that's half of it with tax planning, is just getting the deduction earlier and pushing off the income. So there's a little bit of flexibility there. Look as you come to year end what you could do to kind of push off the income, pull in the expenses before the end of the year, and that could substantially reduce your income this year. Then I think the last tip we wanted to talk about today is a qualified business income deduction, and Jack gets that one.
Just to follow up on both of your last topics, the general rule we use in accounting, right? Defer income, accelerate expenses. And in some cases, you can't do much. But here's a question I always get. People who own real estate, say it's investment property. Well, guess what? If you're scheduled to do the close in December, maybe it's not a bad idea to see if you can put off the closing until January 2nd. That's a huge deferral. And I get that question a lot.
It's not a day or two.
No, yeah, absolutely. And so that's something to think about. QBI, Qualified Business Income Deduction. That was a brainstorm that was created in the 2018 Tax Reform Act. And And the basic rules started out in that instead of having to report 100% of your income, if you were in business either as a sole proprietor or you were a subchapter S, does not apply to C corporations, but if you were a subchapter S or a partnership or a sole proprietor, instead of having to report income on 100% of your income, you had to report income, you had to report taxable income of 80%. So you kind of got like a 20% discount, which is a pretty good deal. But as everything in the tax laws, the devil is in the details. And there was a number of things that affected how much of that 20% you could actually get. There were income limitations, and of course, the real killer for us as CPAs is that if you were in certain professions like attorneys, doctors, CPAs, they had a whole separate set of rules that could have disqualified you from getting that 20%. And I remember when we first learned about this new rule, I remember we went to a continuing education class. We're pretty smart people. We figured out pretty quickly, I don't want to say that it was possible to game the system, but the truth is many times people were involved in many different businesses, but under one umbrella. And so reporting your income as one entity could have disqualified you from getting the 20%. For example, if you had separated those business entities, while you couldn't have gotten it on some income, you could have gotten it on other income. And the example I always use is we happen to have many chiropractors as clients, and chiropractors are doctors. So the income from their practice was subject to the more stringent, harsher rules on that qualified business income deduction. However, many of these doctors actually were in another business. They may have done vitamin supplements, retail, and other things that were kind of related to being a chiropractor, but it really wasn't for their services as a chiropractor. Well, the income from that business was not subject to the more stringent rules. And so when you took a look at the sources of income, if you could separate the income into the income that was from, say, being a doctor or a CPA, into other sources of income, you were able to take advantage of that 20% QBI deduction. And that's something that I think that your CPA should be thinking about. And I know we do it when we look at our tax returns. We kind of have an idea in mind as to what the outcome should have been. And then we look and see, well, why didn't we achieve that result? And maybe sometimes it's because of the way income is reported. So a lot of strategy involved there.
And making sure you're even getting it. I've had a few new clients this year where we're looking at the 2019 taxes that we've gotten where they just didn't give them the QBI deduction at all. So I've seen that missed on a lot of returns.
I look at tons of returns. I review other work that other people have done. And the first line I look at is the line for QBI. And if it's blank, right away I'm thinking something's wrong. And also, here's another thing.
Usually that's a large adjustment.
And it's a large one.
Yeah.
And here's the other thing. It applies to rental properties as well. And so it's not even just the income from your business. You get a positive taxable income on a rental property that actually qualifies for the QBI. It is an item, to be fair, it's an item that could be easily missed if you're not looking for it. You almost have to know what to look for just to be able to figure out it was missed, if that makes any sense. So, great point.
And like you said, Jack, we look for that specifically to say, why did it not come out to what we were thinking?
Literally the first, when I review all these returns that other people have done, in my mind, mentally, I have a checklist of the key things. And one of the first things I look at is the line for QBI. Because like Lisa said, many times it's a huge number, huge. I mean, 20% of a number could be a big number. Yeah. Okay. I think at this point, maybe we like to throw it back to Lindsay and Courtney. And I know we've gotten some questions in, and we can, if they'll give us the questions, we can try and go over them today. If we don't get to your question, or it's something that's really specific to your situation, you're certainly welcome to call your partner, and we'll take the phone call. And let's see what we have here. So The first question is actually,
Hold on, Lindsay, I'll read it to you.
Jack, we're gonna try to get them in order real fast
Sure,
from when
yeah.
they came in.
Sure.
But we did have a quick one that says, what does QBI stand for? That's qualified business income for that one. And then let me go back to the first question that we have here. Hold on just a moment. All right. Should you make your charitable contributions from your personal account, or if you own a business, should you make it from the business account?
Yeah, I would say for this above the line deduction, it would have to be from your personal account. If you take it from your business account, now, in the rules and regulations that I was reading, it was getting a little bit confusing and complicated on the flow throughs, because like if you say you have an S corporation, I normally advise my clients, go ahead and make your donations through your S corp. You don't get the tax donation at the business level, it flows over to your personal return. I'm gonna, I think, wait until we get a little bit further guidance on how that flows over to you onto your 1040 for this above the line deduction, unless someone can chime in here afterwards. But I'm not real sure on that piece. But to directly speak to the line item of the CARES Act that I was referring to, that is a personal, out of my personal pocket to a qualified charitable organization from me personally, not my business.
And Lindsay, I think we should qualify, because I get this question a lot. When we say cash, by cash, we mean not goodwill donations and clothing and stuff. Cash also means check, wire transfer,
Credit cards.
Bitcoin, I guess. But it doesn't have to be literally cash. I get confused a lot.
Wampum is out.
Correct, yeah.
I believe if you've already done some through your S corporation, we'll be able to reclassify that.
I think that too.
And I think it's gonna be there.
Right.
Again, it's not a deduction that I would say, run out and make a charitable contribution, because you're only saving the taxes on it. But if you've already done it or planned on doing it,
Yeah.
you're gonna get a little extra tax help this time.
Right, especially for those people who are not itemizing their deductions, and after the 18 tax law, tons of people who used to itemize ain't itemizing
Yeah.
anymore.
Yeah, it's a
So
big
yeah,
difference, yeah.
it's a big difference, yeah.
Okay,
Okay.
thank you. Next question we have, do I have to write off the health insurance premium as part of itemized deductions? Or can I take the standard deduction and also write off my health insurance premiums?
If you're, that's fine.
Depends.
Yeah, if you're in business and you have health insurance premiums, that ends up being an adjustment before you get to AGI.
It
That's
can be a
nothing-
good deduction.
Yeah, doesn't have to get included with your itemized deduction.
So that would happen if you're an S corporation owner that takes compensation, or if you're self-employed, to the extent that you have self-employment income, you can take it above the line.
Yeah.
And that any excess would go to.
And I know
itemized deduction.
that's my client asking the question, by the way.
Oh.
So I apologize for not emailing you back the answer, but I knew you'd be calling in today, writing in today, Doc. So I was just holding off the answer for this Zoom meeting.
Okay, thanks. Question. Are there specific qualifications or rules for taking a no-fee retirement account withdrawal in 2020 per the CARES Act? Do we have to prove financial hardship?
Yes,
Yes.
there are specific rules. You do have to prove that you have been directly affected by COVID, and the language very specifically says what that is. It is on that irs.gov website. You could search that. I can tell you that it has to do with getting COVID, having a COVID diagnosis, losing a job, your spouse being affected by this. And there are a few other specific things. But yes, when I first saw that, I thought, ooh, I might take money out of my 401k and do something else with it. And then I read down the list and I said, okay, well, knock on wood, fortunately, that doesn't apply to me, but I can't take it.
In general, it needs to be a financial hardship.
Yeah.
But you know what I've been telling clients too, go back to the administrator of the plan, because at the end of the day, they have some say on what, they're gonna give you what their rules are too.
Well, interestingly enough, we did a class not too long ago, and I didn't realize this, not all plans qualify for that. So I've had a lot of clients that are calling saying they want to do it. You might not even be eligible for it.
That's a good point.
Your plan actually had to be modified, And so step one, if you're even considering it, is to reach out to the administrator and
Find out,
see
yeah,
if it's
right.
even allowed from your plan.
Yeah,
And
so
then I believe it's a self-certification.
Mhm.
So even though there is this requirement, it's, you're gonna sign off and certify that,
Then
that
it
you
happens.
qualify for
And,
the.
and if I think I'm correct on this, it has to be like a defined benefit type plan, or like a 401k, for example. I don't think
by contribution.
No.
IRAs don't count.
No, they don't.
Right,
Right, it
so,
has to be a.
right, so that's why we're saying maybe go back to the administrator, because at the end of the day, they're gonna be the one who's writing you the check. And so I think you need to go back to them.
Definitely.
Okay, thank you. Okay, we have kind of a 2-for-1 question here. I believe this is a right answer, or right question together, I guess. Lisa, are the SBA unforgiven amounts taxable income? And if so, wouldn't the corresponding expenses be deductible? You said expenses paid from forgiven funds would not be deductible, but what about unforgiven funds? And I think the person is asking about the EIDL loan as well, if these deductions qualify for the EIDL as well.
So anything that's not forgiven with the SBA actually becomes a loan. So therefore, you would be able to deduct anything you paid. It would be like a normal loan and you pay expenses. So we're really talking about forgiven funds expenses. So assuming that you got the money, used it for all eligible expenses, you would be able to deduct. If you're someone that got the money, didn't use it like you were supposed to, and it's not going to be forgiven, you can deduct whatever you want because you're not getting it.
But then you gotta pay the money
If
back.
forgiven, it's actually a loan.
Yeah.
And the EIDL loan, I actually didn't bring up because it really doesn't come into taxes at all. It's an actual loan you receive, you pay back. It really has nothing to do with deductibility of taxes, except for the little bit of interest that you pay on it would be tax deductible.
And of course, any expenses you paid with the IRS.
Oh, would be deductible.
Would be deductible.
Right.
Only the forgiven loan amounts, the expenses against that have to be brought, not deducted.
Could we, I'm going to do a follow-up too, to the forgiven part. I mean, I know a lot of the clients are getting emails from the banks saying, we want you to apply for the loan. And of course, everybody wants to get this thing over with. But I think as Lisa said, there just doesn't seem to be an upside for applying for the forgiveness at this time. Because they had, after the 24 weeks, they had another 10 months to apply for the forgiveness, which would take everybody into 2021. Why not just wait and see what happens if they'll change this tax law having to do with this deduction?
And I also like to point out to people, every time they've come out with their, I don't know, 56 revisions or whatever to it, it gets a little bit better every time. So there is a chance you're gonna go through and do something that maybe at some point in time they say, that doesn't matter anymore. So there's really no incentive to hurry up and get
Right,
this
and if you
done.
did do this and they changed the law, who knows if they make it retroactive? They're
Right.
just, when you weigh the upside versus downside, there is no upside in doing this. And I think our thought process was, you know, depending upon how much money you got, depending the type of business you're in, if you lost that deduction, say you were a restaurant and you got $1 million, and now you spent the $1 million on payroll, so you clearly applied for the forgiveness. But if you're in the restaurant business, it still pretty much sucks.
You probably don't have the money to pay the taxes.
You're not gonna have
Yeah.
the money to pay the taxes, and I just can't believe that the government is gonna let these people out there hanging out there on this. They have like, people would be owing the government tons of money. So that's why we're thinking that hopefully they'll come to their senses and change that rule, so.
And we at Campbell Jones Cohen are writing our representatives and getting on them for it. So
That's
we're
right.
doing our part.
And when they say a letter coming from Campbell Jones, let me
It
tell
has a
you
lot of
something.
weight.
They're
Yeah.
putting that on the top of the
They
pile, that's what
are.
I got to say.
They
That's
said
right. What other questions we got?
We have just a few more here. If we don't have a payroll company and we want to run a check for the end of the year, where do we go?
We need a payroll company.
Yeah, I think for starters, you're gonna start by calling me and saying, hey, can you refer me over to a payroll company? Because I'd be happy to do that for you and get you our good CJC pricing as well. But if you're doing your payroll on your own, contact your partner and your partner will get you probably in touch. They'll assist you. We'll get you upstairs to our bookkeeping department. to be able to work with you on it. But again, be prepared when you call in and ask us, we're gonna be pushing those payroll companies for you. The tiny little fees that you pay to the payroll companies every year, one tiny mistake that's done, it's covered by for the whole year for the penalties and interest. And you should be running your business. You shouldn't be focusing on, how much deduction should I take? Yeah, payroll compliance. It changes just as much as the tax rules change as well too. So I'll get off that soapbox for this 5 minutes. And I'm going to say, since it might be too late now for the end of the year, because you're not going to start a payroll company today, reach out to your partner, and your partner will get you to the right staff member here that will definitely assist you.
But Beth, I think another important thing to bring up, because I get that question a lot, they think it's as simple as running a W-2 and on the payroll. You have to be set up with the IRS to pay your 941 deposits. You have to be set up with state unemployment. You have to pay a modified business tax. You have to pay federal unemployment tax. It's more complicated running even one payroll than most people think, which is why Beth's saying call a payroll service.
Yes.
And
And
listen,
actually, we're way more expensive than that when you go
Yeah.
through us. So
Right.
it really does work out to go through. a
and
payroll
how many
service.
times do we see where clients have tried to do this on their own and they screw it up?
It's
And
bad.
they get very frustrated. It's
It's
awful
It
frustrating.
is an absolute nightmare to try and fix. That's all I
Right.
can tell you.
And
go
way
back-
more expensive.
And way more expensive. To go back to what Beth said, what you're gonna pay the payroll company is gonna be nothing to what you end up having to pay the IRS and penalties
Right.
for not issuing W-2s. I've seen
Or to
that.
pay to us.
I don't know
to
how
help you
many
fix
times
it.
I've seen that, where they do all the payroll returns and they never issue the W-2s.
Right.
It's the penalties are huge. Or someone would say bigly.
That was a big soapbox.
Yeah.
Okay? What else we
Okay,
got?
just a couple more here. Is it possible that the tax rates will change for 2021 depending on who's in the White House?
It's possible.
For 2021.
I doubt it only because they still have to get it passed and they a lot of times don't like making things retroactive. So you figure he's not gonna take office till January.
That's true.
Who knows when they'll get it done. I do,
Except you and I were alive, Clinton made it retroactive. So
And we made it.
I have seen it, so it's possible.
Gary,
Congress, both houses of Congress and the president have to do it to change something. At this point, it looks like, if there is some changes, it might be the following year, but it's definitely possible.
Gary, you and I were alive when they had the first income tax in 1913. I remember like it was yesterday.
I remember writing that check.
That's right. It was a one-page return.
Oh, you're gonna like this.
Okay.
We have two from the same person, actually three from the same person. I can answer one of those. You want to prepay your tax preparation fees for CJC. Who do you contact? That's me, Lindsay. You can contact me and I will take your money happily. It's Lindsay.
Just call me and I'll meet you out back.
We accept all denominations, non-consecutively numbered, obviously. Yeah.
Okay, so that's that. If you want to prepay your accounting fees to CJC in 2020 for 2021, who do you contact?
Lindsay.
I think that's the same person. Yep, that's me. And then in our latest newsletter, deductible gifts are listed as taking year-end actions. How does this differ from charitable giving?
I think that's the same thing.
Same thing.
It's just different words. It's the same thing.
Okay. All right. Are political contributions tax deductible for business?
No.
Never were.
No.
Never were.
Okay. We just have one more question. To issue two types of 1099 forms for 2020, NEC and miscellaneous.
Yes.
Yes.
Yeah, they brought back the NEC form. It was a form that they used to use a long time ago. They tried to make it easy on us in the years past by combining that form into one. And then they changed the due dates of everything when the 1099s were due. It was just getting very complicated. So unfortunately, and fortunately for us, but unfortunately, you do have to file two separate returns this year. The 1099 NEC is for your non-employee compensation. That would have been anything you normally would have put in box 7 on last year's 1099 miscellaneous forms. And then all your other items, your rent, things like that. I think attorneys still stay on the regular 1099s. I'm going to take that one off the table this 5 minutes because there's two different attorney fees. But there are different ones, your doctors, things like that. Those are going to stay on the regular 1099s. Your NECs are for anything that would have been in box 7 of last year. Now, I'm gonna go back on a soapbox here for a minute for CJC. Now you have to buy 2 different sets of forms. You have to make sure you're filing the right 1096s. You have to make sure you have the right deadlines in place. We offer this service every year to our clients. So if you're doing 1099s, I was just talking to a client the other day. She's like, can you just teach me how to do it? And I said, you know, kind of the old adverb, teach a man to fish, he eats for a day, or fish for a man, eats for a day, teach a fish, eats for hour.
We got it.
We get that part of it. She says, well, I can't do it myself next year. And I said, well, think about it. You're going to pay us to do it, and then you're done. You don't have to go through your QuickBooks looking for them. You don't have to make sure you got everybody. But the biggest sell to her was trying to get the forms. You have to, and
You buy them.
if you only need one, they don't really sell one. But you can go online and try to download it or try to get order it from the IRS or something.
Right, it can't even be downloaded.
Yeah, you can't download
Yeah.
them. So if you only have like 1 to 5, you know, you can really buy them in packs of 25, so you're gonna waste your money every year. So make sure, reach out to us, reach out to our bookkeeping department, say, hey, help me with my 1099s this year. It'll be a lot easier.
Or if you have payroll,
Oh, yeah.
through a payroll company, they'll do the 1099s for you as well. So,
Hey, Lindsay, can you throw a shout out to Silver State Payroll? I saw them pop up on there on the,
Yes.
Or-
I'm just going.
one of our
I
attendees.
wasn't sure if I was allowed to do that, so. We have a payroll company, Silver State Payroll Services LLC. If you want to write this number down, we'll put it in the chat box. 702-522-1789. They'd love all of our clients for payroll. Not in there.
I believe they make cookies.
Oh.
So after that, that actually concludes all of our questions. If you did have a question that wasn't answered during this webinar, please email it to
and I
office@yournevadacpa.com.
we think that they're gonna come out with more stimulus money, they're gonna come out with more, you know, SBA
They're
money.
definitely talking about another,
Yeah,
I mean,
yeah.
there will be another bill. They're talking about
Sure.
more stimulus, another round of PPP, which we'll
Sure.
be helping people with as soon as we know about it.
So, yeah, so our intention would be to continue doing these Zoom meetings as we get.
So
additional
watch for your email. If
Yeah.
something comes out, we'll certainly be doing one.
Yeah, put it on our email blast,
Yeah,
yeah.
Gary's been begging for season 2 since season 1 started.
Oh, we're almost to season 2.
Yeah, I want to be on Netflix.
Watch Gary Friday nights.
All right, well.
All right,
thanks.
that concludes this webinar. We appreciate you guys joining us today. I hope you got some great information out of this, and we hope you have a happy and safe holiday, and we will be in touch with you for the next tax season. I hope you all have a great day. Thank you.
Bye.
Bye.